Well, good afternoon, everyone, and welcome. My name is Daniel Goot, and I am joined here by my good friend and colleague, Doug Garrison. Now, for those of you that are new to our series, I wanted to take just a minute to briefly introduce our company, Investec, and the services that we offer. So, Investec is a boutique wealth management firm that was founded by my father, John Goot, in 1984. And for over 35 years, we have been helping our clients save for and transition into retirement. We've had the good fortune over those years to work with now over 45 ExxonMobil retirees and their families. So we have a lot of experience working with people just like you, understanding your benefit programs and helping you transition into retirement. Now, as I mentioned, Doug Garrison is joining me here today. And Doug is not only a senior wealth advisor with Investec, and he's been with us over 10 years now, but Doug Garrison is one of you. And what I mean by that is Doug Garrison worked for over 30 years at ExxonMobil in human resources, the last 10 of which were in the benefits design department. We are so fortunate to have Doug on our team. And just to give you an inkling into the kind of guy that he is, last year, Doug Garrison donated one of his kidneys to one of his daughters. He put his life on the line to be able to save his daughter's life. And we are so blessed to have him here with us today and to have him as part of the Investec team. So, Doug, I'd like to turn it over to you to join me as well.
Well, thank you, Daniel. You make me sound like I'm a little old and missing a few spare parts, but I appreciate the introduction. I want to say to our listeners, thank you very much for joining us on this part 3 of our 3-part webinar series. I realize that for many of you, it's been a long day, and for some of you, the day's probably not over yet. These are challenging times at ExxonMobil. You may want to grab a cup of coffee and try to clear your mind, and we hope you learned something valuable this evening. Daniel, for his part, joined Investec in 2003, following a 4-year stint getting his feet wet in the financial services industry, working for a large Wall Street firm out in California. He's a father of 3 and very active in the community. Let me say big picture what we hope to get out of today. A lot of people have fear of running out of money when they're no longer drawing a consistent paycheck from ExxonMobil or another employer. And I'd have to say my wife was one of those. She worried when I retired from ExxonMobil. But we're hoping that by sharing our experience and our knowledge today, you will be able to allay some of those fears and make you a more sophisticated retiree and know more about smart ways to fund your retirement. Now, as Daniel's mentioned, we've had a lot of experience with ExxonMobil employees and retirees over the years. And if you're considering working with a financial advisor, we'd ask, you've had some exposure to us over these 3 webinars. You may have decided whether we're the kind of folks that you'd like to talk to. We'd certainly be interested in continuing the conversation, and maybe after you've seen this presentation, you'd like to continue to have a face-to-face, or I guess I should say a Zoom-to-Zoom conversation with us. We hope it's worthwhile for you. Hold your judgment till the end.
Yeah, so a couple of housekeeping items before we go any further. If you have any questions that you'd like to ask us during the webinar, please do type them in either the Q&A or the chat function that should be at the bottom of your screen. And we're going to try to answer the questions as they come through during the webinar, but certainly we will address all of them by the end of the webinar. And lastly, we will be sending out a recording of the video as well as a PDF of the slides in the next day or 2. So anything you see on screen, you don't have to jot down very quickly. You will be getting copies of the slides to follow. So having said that, Doug, I'd like to turn it back to you and ask you to please summarize steps 1 and 2 for those that are with us here tonight that may not have been able to join us for either of the first 2 sessions.
Be happy to, Daniel. You know, folks, when we were conceptualizing this webinar series, we thought about retirement and exiting from ExxonMobil as a sequence of events and activities. First session 2 weeks ago started to talk about retirement readiness. Are you psychologically or emotionally ready for retirement? You're going to create a new identity. Your activities will be different than what you have at the office. You may be spending more time with your spouse. You may have different activities to do. Are you emotionally and psychologically ready to leave the workplace and become a retiree? Then we also talked about the financial perspective. Do you have enough money? We talked about different rules of thumb, and we talked about the advantage of doing a financial plan to assess your financial readiness for retirement. Then we went into optimal timing. When is the best time for you to retire? We talked about the lump sum interest rate as a factor. We talked about whether you might get some taxable non-qualified benefits that might kick up your income and increase your taxes, whether working another few months or into the next quarter might benefit you. And finally, we talked about in the second session, 1 week ago, we talked about the two big benefits that folks coming out of ExxonMobil have to help them through retirement. The ExxonMobil pension plan, lump sum versus annuity or some combination of both. We also talked about the ExxonMobil savings plan and some of the options that you have with that, including a discussion about net unrealized appreciation, or NUA, on low-cost ExxonMobil stock. And finally, last week, we also talked about the mechanics of taking a distribution of your ExxonMobil savings plan. Daniel, how about telling us what we're going to talk about today?
Sure, would love to, but before we get into the topics of today, I want to first talk about fear, and I want to contrast the kinds of fear that little children have of the unknown, right? Things like the scary monster under your bed or in your closet, to the fear that an adult has of the known. And some of those fears are fear of public speaking, maybe the fear of an IRS audit, or the fear of not having enough money to maintain your independence. And today we're going to address that last fear, how to ensure that you don't lose your financial independence and have to rely on your children to move in with them. So we're going to talk about 4 topics today, and we hope that you can learn something new from each of them. But more importantly, we hope that you're comfortable enough to be able to call us after this webinar series to discuss your personal situation. So the 4 topics that we're going to talk about today. Number 1, how can I generate a monthly paycheck in retirement? Doug's going to cover that next. Then we're going to talk about tax matters. We're going to talk about how to invest in a tax-efficient manner. The third thing we're going to talk about is spending order. And what we mean by that is I have all these different accounts. Which do I draw from first in retirement? And the last thing we're going to talk about, we're going to conclude by talking about what help a financial advisor might be able to provide you. So without further ado, Doug, if you could take it away and talk about the monthly paycheck.
It's a good issue, getting your monthly paycheck. This chart has a couple of 3 boxes on it. If you look at the far right, upon retirement, you hopefully will have a lot of money that you will want to invest to keep up with or exceed inflation. That probably will be divided between bonds and stocks. And that portfolio has sort of a time horizon, at least at Investec, of 3 to 5 years. That's sort of the time horizon that we're looking for as we choose investments for that investment portfolio. But we'll also work with clients to determine what do they need on a monthly basis to support their living expenses. How much money do they need each month? They were used to getting a monthly or a semi-monthly paycheck from ExxonMobil. Now they don't have that paycheck, but they still have expenses. So how are we going to get them a monthly paycheck? Well, we'll carve out of that investment portfolio a year or 2 of cash of what they really need and invest that in very, very stable kinds of investments like money markets or short-term bond funds. And then once a month, that middle box, the distribution portfolio, will pour into their checking account their monthly paycheck. The advantage of this is that distribution portfolio is pretty much immune from the ups and downs of the stock market. So people who might otherwise fear having to sell some of their portfolio when the market takes a dive as it periodically does, like in 2008, 2009, or even in March of this year, instead of worrying about having to sell something at that point to generate cash for their monthly expenses, they've got the distribution portfolio with a year or two of cash so they can sleep tight at night and they get their monthly paycheck every month from Investec. Let me turn it over to Daniel to talk in a little bit more detail about the investments that are in that investment portfolio.
Yeah, thank you, Doug. Our business, like many others, is filled with acronyms. And one of the first ones I learned when I started 20 years ago was SWAN, which stands for Sleep Well at Night. And that slide and what Doug just covered is really one of the benefits that our clients get, the ability to sleep well at night, even during down markets, knowing that they have that buffer in their investments to withstand the downturn. So let's turn to tax efficient investing. Investing your savings is a pretty complex thing to do. Some of the things that you want to look at when you're evaluating investments is the growth potential of that particular investment. With that, though, comes the risk, right? What's the risk of that investment that you're looking to invest in? Number three is the cost of the investment, right? All different investment products have different fees and costs associated with it, and you want to make sure that you have as low a cost as possible. And the fourth thing is the tax consequences. And that's really what I'm going to focus on for the next few slides. At Investec, we focus on all of those areas and others, but the tax element to your investments is such an important one that we can't stress it enough that we're going to dedicate a whole section of today's webinar to it. So one of the core tenets of our investment philosophy at Investec is diversification, right? Obviously, you've heard of diversification before. Another fancy way of saying that is asset allocation. And so I'm going to briefly describe what asset allocation is to those that may not be as familiar with this term. So asset allocation in its simplest form is the art of diversifying your portfolio between major asset classes.
Daniel, is that sort of like when grandma said, don't put all your eggs in one basket?
That's exactly right, Doug. You got to love the simple wisdom from grandma. But yes, don't put all your eggs in one basket. Diversify your investments. Invest in several different types of asset classes, as you can see on the screen, right? So investing in large company stocks here in the US, investing overseas, investing in bonds, investing in commodities, etc. Lots of different investments that one wants to have in their portfolio at all times to have that diversified portfolio.
Daniel, if I could interject, why do you recommend asset allocation so strongly? What's the benefits of asset allocation?
Yeah. So really, Doug, the biggest benefits of having diversification and an asset allocation in your portfolio is the ability to reduce risk. By investing in each of these different kinds of investments, parts of your portfolio will zag when other parts zig. And we would all love to have only the things that are going up in our portfolios at all times, but we all know that that is an impossible thing to do, to only invest in things that are only going up at all times. And so what we strive to do through asset allocation is invest in several asset classes that can balance the risk in your portfolio according to how much volatility you're comfortable with, what your time horizon is, and what your goals are. So all of those factors come into play. Now, at Investec, we like to think differently and not only invest using a tenet called asset allocation, but as you can see now on the screen, we also incorporate something called asset location. An asset location is where best to locate your investments among your various accounts. We all know that different investments have different tax consequences, right? Municipal bonds, tax-free bonds, are tax-free. The interest that you earn, you don't pay any tax on that interest. Whereas dividends from corporate bonds, you pay ordinary income taxes. Match that with gains that you may incur after you've sold an investment. If you've held it for over 12 months, you get a favorable tax break in that you have to pay long-term capital gains taxes, which may be 10 or 15%. So different investments have different tax consequences to them, and I think most investors are somewhat familiar with those. What we do at Investec, though, is not only match the investments that you own, but we carefully place them in the right account that you have as well. So whether you have a Roth IRA or a traditional IRA or a taxable account, knowing which investments to place in which account is very important and can go a long way in saving you in taxes over time.
So, Daniel, that raises the question that some of our viewers may have. How do you really know which kind of investment goes into which kind of account?
Yeah, so Doug, that's a good question, but I'm going to ask you to hold that thought because in 2 slides, I'm going to go over just that. So we're going to start with the first investor. And what we're going to kind of show you here is asset allocation. Again, you're probably familiar with this. Our first investor here is named Homer Simpson. Homer Simpson is a moderate risk type of investor. And with that, he has roughly 60% of his portfolios in stocks and 40% in bonds or fixed income. And as you can see here on the slide, Homer has done a great job in his career of saving money in various accounts. He's got an individual account, he has a pension, rollover IRA, a Roth IRA, and a 401k. He's got all these different accounts, and he's a moderate investor. Without asset location, what Homer would do is invest each of these accounts with the same funds in that 60-40 mix, not taking into consideration the taxes of the investments and matching them up appropriately with the tax characteristics of each of these different accounts.
If Marge Simpson had an IRA, do you suppose she'd invest the same way?
If Marge Simpson had an IRA as well, then and assuming she was also a moderate investor and was invested like Homer in 60-40, then yes, she too would have yet a 6th account here invested in the same funds as Homer, in the same allocation of 60 stocks and 40 bonds, again, duplicating it all over again. So what we want to show you is investor number 2. And investor number 2 uses asset location strategies. And the name of our investor number 2 is Albert Einstein. So we're going to kind of look at how he invests his retirement savings. Now, Albert, like Homer, has done a very good job of saving over the years and has opened the exact same types of accounts that you see on the screen here, the same 5 accounts. But what Albert has done differently is he is investing in each of his accounts the appropriate investments that go in them. So Albert located, right, the most tax efficient part of his portfolio, which are tax-free bonds and large cap stocks, in his individual account. He then locates or invests really the most tax inefficient part of his portfolio, which are the dividend paying corporate bonds, and he puts those in his rollover IRA. And the reason why he does that is those types of bonds, you have to pay ordinary income on the dividends that you earn from those bonds. And so why not put that type of investment in a rollover IRA that enjoys tax deferral until you take the money out? Now, lastly, what Albert does is he invests more of the growth-oriented types of investments in his Roth IRA. So here he invests emerging markets in his Roth IRA because of his time horizon with the Roth and the tax benefits of the Roth being completely tax-free. Money's growing tax-free and being withdrawn tax-free. So hopefully I've done a decent job of explaining the benefits of asset location, and when mixed together with asset allocation, what you find for an investor like Albert is that you own fewer funds across your portfolios, which does reduce your trading costs. You also save on taxes over time, all the while not increasing your risk, and at the end of the day, enhancing your overall return and the performance of your accounts. So we'd like to say that Albert, in this case, is really enjoying the best of both worlds. Now, whether that means drinking a turnip shake or a squash slushy, or in our case, it means reducing taxes while not increasing risk, again, we'd like to offer you a free evaluation of your savings, and so we can see how we can help you invest in a similar manner. Now, Doug, I've done enough talking for now and want to grab some water. Can you please talk about the third topic of the evening, which is how to draw down your money in retirement?
Well, Daniel, I'll give it a shot. I'm sort of intrigued with the best of both worlds, lower taxes, fewer trades, no greater risk. That sounds pretty good. Maybe we can find another good idea to add to the mix. Now, we've covered the idea of a monthly paycheck. We talked about the distribution account and filling up the monthly paycheck. And we've talked about the idea of asset diversification and asset location. But let's connect those ideas. How do you choose from which account you want to take the money and in which order? Well, there's conventional wisdom that's pretty straightforward and kind of simple. This is maybe something that your Aunt Betty or your Uncle Jack might be following. First, you spend after-tax money. There's no taxes when you withdraw that from your brokerage account. And you basically defer taking any money from those tax advantage accounts of the IRA and the Roth. So after you finish spending down your after-tax money, then you go to your traditional IRA account and begin drawing money down there. And then finally, if you run out of money in your IRA, conventional wisdom would say you ought to go into your Roth, saving it for last, because if you don't spend it all, it's a dandy tool to leave to your heirs, tax-free money. They'll remember you well if that's what you leave behind. Well, now let's look at an example and see what it looks like in sort of practicality here. How might this work out in practice?
Doug, if I can just stop for 1 second. I just want to encourage everyone again, if you have any questions along the way, please do use the Q&A function so that we can answer any questions you have. Sorry, Doug, sorry for cutting you off.
No problem. So how might this work out in practice? We've borrowed a chart from Fidelity. The numbers are fairly modest. You see the portfolio on the left, but it illustrates how conventional wisdom might work. This is Uncle Jack's portfolio. It consists of 3 different accounts: a taxable account, a tax-deferred account, and a Roth IRA. He needs, let's say, $60,000 per year to live on, and he gets, let's say, $25,000 a year, $25,000 a year in Social Security benefits. The top of the chart shows his withdrawals following sort of conventional wisdom, where he starts taking withdrawals from his taxable investment account or his personal savings. It's basically after-tax money. And because it's after-tax money, he doesn't pay any taxes on that. It's not enough to kick him into a tax-paying bracket. Now, Uncle Jack's late wife was an accountant, and as an accountant, she loved to tell people, don't pay taxes until you absolutely have to. Well, Uncle Jack will make her proud by not paying any taxes as he withdraws all of his after-tax money. But eventually he's going to run out. Along about the end of year 7, it looks like he doesn't have any more after-tax money, so he has to begin withdrawing from his IRA. Now, as most of you know, any money coming out of an IRA is going to be subject to federal taxes, so that will increase his taxable income, and as a consequence, Uncle Jack's going to have to pay taxes. If you look at years 8 through 18, at the bottom of the chart, you'll see he's paying close to over $5,000 a year in taxes because his income has gone up as he's withdrawing his taxable money from his IRA. Well, eventually Uncle Jack runs out of money in the IRA, and then he has to resort to his Roth IRA. But because the Roth is tax-free, he ends up not having to pay any taxes in the final years of his life. Over the course of his retirement, Uncle Jack's had to pay about $70,000 in taxes. Could there be a smarter way than following conventional wisdom? Let's look at another example. Here's another example that sort of flies in the face of conventional wisdom. You see here, this is Uncle Jack's brother, Uncle Will. Same savings, same cash needs, but he decides, because of his savvy financial advisor, that he's going to withdraw proportionally across all three of his accounts over his retirement. So he's basically taking advantage of the progressive nature of our US federal tax code. Lower income pays a smaller percentage of income in taxes. So he's taking taxable money out of his IRA over the entirety of his retirement rather than bunching it into a few years like Brother Jack did. So he ends up paying only $43,000 in taxes versus his brother's $70,000 in taxes. The result of this is that Uncle Will's portfolio lasts somewhat longer because he spent less of his portfolio on taxes. And if you can blow this up for a portfolio of $1 to $3 to $5 million, this kind of creativity can make a real difference in how long your portfolio could last. This is one example of how being creative on withdrawal strategies can lower your taxes. There are some additional benefits from not following conventional wisdom, which we'll look at next.
Doug, before we get to that next slide, a question did just come in, and I'm just going to read it to you here. What happens if tax rates go up in the future? What effect could that have on a strategy like this?
Well, of course, it depends on what the new tax code actually says, but I suspect we'll not depart very significantly in the foreseeable future from a progressive tax system where the more money you make, the higher the taxes are. So Uncle Will can continue to spread his taxable assets across his retirement. And depending on the tax code, he may pay more or less than what's shown here, but he will likely pay fewer taxes than Uncle Jack, who bunched his taxable income into those 11 years between 8 and 18.
Gotcha. Okay. Thank you. Maybe I don't see another question yet, so maybe we cover the benefits of questioning conventional wisdom.
All right, let's start by considering your tax rate over your years of retirement. Most of our clients, most ExxonMobil retirees, are going to have a lower tax rate between retirement and age 70 when perhaps Social Security kicks in, or at age 72 when they have to start taking required minimum distributions from their IRA. So in these lower tax years, you don't have a paycheck, you're not taking Social Security, you're not taking money out of your IRA, you're in a lower tax rate. What might we be able to do in that magic period? Well, number one, you can postpone taking Social Security, which will maximize your benefit. If instead of taking it at 62 or 65 or 67, you allow it to grow over time until age 70, you'll maximize your Social Security benefit. That's a valuable planning technique. And to do it, you may need to take money out of your IRA to live on. Well, what's the problem with doing that? There's no problem particularly other than you have to pay taxes, but at a lower rate. But the other thing is you may reduce eventual required minimum distributions because you've taken money out early rather than when you have to. You've brought the balance down from what it might otherwise be. Another thing that you might consider doing during those magic years of 60 to 70 or 72 is to do a Roth conversion. When you convert part of your IRA into a Roth IRA, you have to pay taxes. It goes from tax protected to tax paid into the Roth. Well, if you're in a lower tax bracket at 60, 61, 62, the tax cost of converting money from your IRA into a Roth is going to be lower than if you waited until 70 or 72 when your income is likely going to be higher. Additionally, there are some creative charitable strategies that can be used to reduce taxes by, for example, compensating for the costs incurred, the tax cost of doing a Roth conversion. These examples are just general. It's not an exhaustive list. Individual circumstances are important, but this gives you an idea about how tax-effective spend-down approach can be developed and hopefully convinces you that the conventional wisdom is not necessarily best for you. But all these examples have sort of assumed that you're over 59 and a half and you can take distributions from your IRA without that nasty 10% penalty. But what if you're not 59 and a half?
So Doug, but before you answer that question you so eloquently posed, a couple questions have come in on this slides that I want to stop you with, and let's address them while we're on the slide. So the first one says, I make too much money. How do I convert to a Roth IRA? My income is too high. I can't convert to a Roth IRA.
Well, actually, Daniel, as you know, there are no income limits on doing a Roth conversion. What the questioner is probably referring to is that there are income limits on making a contribution to a Roth IRA. You, you're limited in making a contribution out of your paycheck to a Roth IRA if you make too much money. But if you are converting money from an IRA into a Roth, there are no income limits. You can do that regardless of your income.
Very good. Thank you. Thanks for explaining that. And there was another one. The comment here is I thought that required minimum distributions or RMDs started at 70 and a half, but you just mentioned 72.
Well, Congress in the final days of 2019 slipped a bill before Congress or in Congress that the president signed called the Secure Act. And that pushed up the age at which you have to start taking distributions from your IRA from 70 and a half, which is a funny number nobody ever really understood, to 72. So you can postpone taking money from your IRA until 72 under the Secure Act.
I guess I'll add to that. This year in 2020, for those that don't know, due to COVID, anyone that is already taking RMDs from their IRA, you are not required to do so in the year 2020. So if you have an IRA and you're already retired, you are not required to take that distribution this year.
Daniel, I might add that that applies to inherited IRAs as well as IRAs of which you are the owner. So if you inherited an IRA from a relative and you've been taking RMDs, you don't have to take that RMD this year. But let's go back then to the question of what are your options if you retire before 59 and a half? Well, as we talked about, last week, you can use low-cost ExxonMobil stock and the NUA strategy to put stock into your brokerage account, sell it, and then generate cash from the sale of that stock to support your lifestyle or to meet your bills. You can also avoid taking a complete distribution from your savings plan account, leave it in the savings plan, and take partial distributions until you do turn 59 and a half, at which time you may wish to take a full distribution and use NUA. You can also make arrangements for what's called a 72T distribution. That's periodic distributions from your IRA, but a technicality, you have to continue that for the longer of 5 years or until you're 59 and a half, and the amount of money that you can take out is not tremendous. And finally, there is the possibility of if you're below 59 and a half, you're still in the workforce for a lot of folks' perspective. You can maybe get part-time or full-time employment or do some consulting. I would suggest that it might be helpful to consider getting some help from a financial advisor to strategize with you in light of your own circumstances. But that raises a question. Who do you want as a financial advisor, and why might you want to work with a financial advisor?
So while we don't think hiring your best friend to be your financial advisor may be in your best interest, we do think that hiring a Doug and not a dog is a pretty good idea. So, Doug, can you help illustrate some reasons why someone might consider hiring an advisor?
I certainly can, Daniel. We have lots of reasons to consider working with a financial advisor, shown here on this slide. But maybe a better approach is to tell our listeners or viewers a few live examples, real live case studies of clients who have come to us and why. I remember 3 in particular. There was these are fictitious names to conceal the identities of those parties, but I remember a couple we'll call Dan and Kathy. He was an overworked ExxonMobil executive close to retirement who just really didn't have the time to concern himself with his financial affairs. He had some outside brokerage accounts that he wasn't really looking after. He had an idea about NUA, but he really didn't know that much about it. And he had some questions about lump sum versus annuity. He had a mother-in-law living with him who was in poor health and had some estate matters. So he really wanted to hire expertise, and he wanted to make no big mistakes. Now, we've seen a few big mistakes over the years. Does anybody out there in the audience remember a film from 1999 called The Sixth Sense? Anybody remember that line that the little boy said to Bruce Willis? I see dead people? Well, that can be a big mistake. Not checking your beneficiary designation form and leaving all or part of your IRA or your insurance to somebody who's died since you filled out that form can leave your IRA to people that you didn't intend it to go to necessarily. So we look at a beneficiary designation form, and sometimes mistakes are made and we see dead people. Let's go on to Bill and Mary. Bill and Mary had lived in a fairly modest home for about 20 or 25 years while he was working for Exxon and advancing in his career. And after a 30 or 35-year career, they decided they would very much like to move to a larger home, build their retirement dream home. But they were a little bit of an anxious, nervous couple, a little concerned about running out of money before they run out of breath. And they weren't sure that they were able to afford the kind of house that they dreamed of. So they came to us, we ran a plan for them, and working with them, we concluded that yes, they could afford to build that dream home and not run out of money before they run out of breath. As I said, they were a nervous couple and they were given to concerns when the stock market went down. And one of the other things that they were looking for was some advisors who might hold their hands or reassure them when the market takes those periodic dips and go through somewhat scary times. So they hired us for our planning capabilities and also to sort of counter their behavioral finance tendencies. The final couple I'll talk about we'll call Steve and Jane. Steve was an engineer. He worked long and hard at ExxonMobil, but towards the end of his career, he contracted a terminal disease. And shortly after he retired on disability from ExxonMobil, he came to us because he wanted to make sure that there was a trusted advisor to work with his wife after he passed. So they were looking for continuity of service and some comfort and peace of mind as he faced his final days. But how do you actually make the decision about with whom do you want to work? Daniel, I think I've talked enough. It's time to turn it to you.
Thank you, Doug. And it's such an important part of what you just went over is that each of you have your own story and your own needs and your own reasons for why you may want to hire a financial advisor. It is not one size fits all, as they say. Now, choosing a financial advisor is a very important decision, right? Not to be taken lightly at all. This is the team of people that are going to help you manage your retirement savings and ensure that you are not spending too much and that you will not run out of money before you run out of breath. So there's lots of different aspects that go into choosing an advisor. We've put some of them on the board here. There's lots of different ways that advisors get compensated, and we think that's an important element that you want to explore and understand how your advisor is getting paid. You want to know what services are included for those fees that you may pay them. You also want to understand how they plan to invest your money. There's lots of different investment philosophies out there. In fact, I had a client call me yesterday to say that his brother's financial advisor is recommending that they go all to cash. And we think that that is really not a good investment strategy because that's market timing. And getting out of the market and trying to get back into the market has proven to be a very difficult thing to do consistently well. And for those that have tried, have gotten burned. There's credentials out there in our industry that you want to make sure that your advisor has experience and the knowledge to be able to help you, not only with your investments, but with a broad array of different personal financial planning topics and services, because your financial life is complex. It may seem easy to you, but it's actually, there's so many different elements that go into it that hiring a professional is worth your while. Now, the last thing that I want to touch on is chemistry. And this is not chemistry from your high school class, but this is the chemistry between you and your advisory team. And we think having good communication between both parties is a very important element. So much so that we wanted to show you a clip from one of our favorite movies. You may have remembered the movie from the late 80s called Uncle Buck, starring John Candy. And this clip from that movie is really how not to develop a trusting relationship with another person.
Where do you live?
In the city.
Do you have a house?
Apartment.
Own or rent?
Rent.
What do you do for a living?
Lots of things.
Where's your office?
I don't have one.
How come?
I don't need one.
Where's your wife?
Don't have one.
How come?
It's a long story.
Do you have kids?
No, I don't.
How come?
It's an even longer story.
Are you my dad's brother?
What's your record for consecutive questions asked?
38.
I'm your dad's brother, all right.
You have much more hair on your nose than my dad.
How nice of you to notice.
I'm a kid. That's my job.
Okay, so we're in the final stretch here, guys, of our presentation. We appreciate your hanging in there. For those that are in Houston or that are baseball fans, we know that the Astros game is still going on now. The good news is they are winning 11-4 in the 8th inning. So good news there. We love that scene from that movie. We know that that's not the kind of conversation that we want to have with our clients, because we know that each of you has your unique story, as Doug outlined a couple different client stories, and we really want to get to know you and your story. Now, a good financial advisor gets to know your money, but we believe that a great financial advisor gets to know you.
And to help us know you better and to provide a little grist for our webinar mill, we'd like you to take a minute or two and enter what topic might be of most interest to you in the Q&A box at the bottom of the screen. There's a lot of material that Daniel and I could put on as a webinar, but we want to be relevant and of interest to you. So if you take a minute or two and just enter a topic, it could be more about ExxonMobil benefits, could be about investment strategies, could be about retirement planning. We'd like to know what's on your mind, what would be of interest to you, and it would help us develop timely and relevant webinars and serve you better. So thanks. Take a minute and help us out.
Yeah, thank you. Thank you for your feedback. As Doug said, hearing from you on topics that are of most interest to you will allow us to produce the best content going forward. And one of the comments that just came in here, I'll just read one, was option tracking. So when to exercise, how to diversify my portfolio when there are restrictions in place. So that is something that we can certainly cover in terms of your stock options at your company. So thank you for that feedback. And there's been some other comments and other feedback, so thank you. We appreciate your giving us some suggestions, and we look forward to putting on more of these going forward. So we hope that you've learned a lot these last few weeks as we've discussed the 3-step process for transitioning into retirement from ExxonMobil. As I mentioned earlier, in the next day or two, you will receive an email with a copy of the recording plus the slides, and also a link to schedule a video call with both Doug and myself. We do think that 2 heads are better than 1, so you would get both of us on that initial call. That call is free, there's no obligation, and during that call, we can review your EMSP allocation, we can talk about NUA and whether or not that may make sense for your situation. We can even talk about what to do now that Exxon has suspended the match. So lots of topics that we can cover in that call. You can also go to our website, which is www.investecwealth.com, and click on the Let's Talk button. From there, you would be able to schedule that complimentary call with Doug and myself. So lots of different ways to get hold of us. And we're confident that we can help you individually, and hope that you give us that opportunity to find out. Doug, are there any questions that have come in?
I don't think so. Well, I just learned of this recently. Can I have access to presentations 1 and 2? I guess you want to respond to that?
Yeah, good point. And you know what, I meant to mention that. So in the recording that you'll get in the next day or two, will not only be the recording of today's session, but on that same website at the very top, we'll have 3 tabs: session 1, session 2, session 3. So yes, you will be able to hear our 2 prior webinars from the same link that you'll get in the email in the next day or 2.
We have another one, question about starting to collect Social Security for this individual spouse who's 3 years older than he is or she is, and he's the primary or she was the primary money earner while the spouse worked inside the home. Generally speaking, spousal benefits for Social Security are only payable when the primary earner on whose record that spousal benefit will be based has begun to draw Social Security benefits for himself or herself. So in this particular case, the spouse, despite being older, if she or he has no earnings record of their own, would only be able to draw Social Security benefits when the primary breadwinner in the family started to take his or her retirement benefits. We work closely with clients on Social Security claiming strategies. They can be very complex. A lot of variables involved. We've got software that shows the net result of several different alternatives, and we work with clients to determine what's the appropriate and optimal claiming strategy for that family. It's a good question. It's a good topic. It's part of what we do.
Okay, just looking to see if there's any more before we close out here, and it doesn't look like there are any more questions. So yeah, so we'd like to close out the webinar series by first of all thanking you for joining us today. And we also wanted to end by just briefly sharing our personal passion for why we are in the business that we're in. So Doug, I'd like to turn it over to you if you could start.
Well, as I said, I guess at the first session 2 weeks ago, this is a second career for me by choice. I really enjoy answering questions, working with people, helping convey knowledge and answers, especially to ExxonMobil people whose benefits I know so well, and helping them get answers and making the most of their benefits is a source of real satisfaction. So what my hope is this series has enabled our viewers to learn some more, to avoid big mistakes, make smart decisions. You know, I know that retirement can be a wonderful chapter in a person's life, and they can even make it better by being smart, wise about their finances, making decisions with discipline and knowledge. So I hope that's been part of what our viewers have received from these 3 sessions.
Good, thank you, Doug. Thanks for sharing that, and really thank you for all of your hard work this past month in putting on this 3-part series. I know it's been a lot of time.
It's been my pleasure, Daniel.
I also want to thank the girl behind the curtain, as it were, Marissa Wilson, who's on the Investec team, who has worked tirelessly over this last month as well, helping us to put on the webinar series, late nights and weekends. So thank you, Marissa, for all of your help these last few weeks. As Doug mentioned in the beginning, I got started in the business over 20 years ago, having watched my father, John, start Investec in 1984 when I was just 8 years old. I was very fortunate to be able to join him 17 years ago and have had the luxury of not only doing what I love to do each and every day, but getting to do it with my father, who is also my mentor in business. So I'm so appreciative of that. And John is still very involved in the business, and on an ongoing basis, I continue to get to learn from him. So I close out the webinar series by inviting you and your family to call the Investec family to see if we can help you as you transition into retirement. So thank you, everyone, and have a great evening.
And I'd like to express my thanks to you as well. I know it's a busy time of the year, and we appreciate your taking the time and hope it's been worthwhile for you. Good luck to you all.